Do you want to also have a movement away in the second half from some of the more defensive areas of the market, whether it's like the staples or, a lot of money's been going into gold and bonds and bond proxies, et cetera?
Well, I think for gold and bonds, you're always going to have, bond flows have been positive for 10 years, so I don't think that's new news. You're always going to have the gold bugs that think we're printing too much currency. I think on the Russell, it's really interesting because if you look at a one-year time horizon, the Russell's down about 8% over the last year versus the S&P and NASDAQ are up about 7.5%. So we can definitely look at the last 6 months and say everything's done really well. But if you stretch that out a little bit more, there's definitely winners and losers. And I agree to, Josh's, the large cap versus small cap. If you look over the last year, it's been extreme. But, we think we're, longer term in a secular bull market. That being said, this weekend, from a shorter term standpoint, is really important because if you look technically at the 50-day and more importantly, the 200-day moving average, about 70% of stocks are above both metrics. And when you get to above 80, it's typically been an extreme. So I think going this weekend, you could either have, a bigger sell-off than anticipated, or you could gap up a little bit. But either way, I think the markets on the short-term basis are definitely overbought.
All right. Do you agree with that, Ron? I mean, you're up 17% year to date as we try and look at sort of what the second half is going to bring for investors.
I'm beginning to rethink a lot of things. I mean, number one, obviously, I would agree that the Federal Reserve is going to probably cut interest rates in July. If you looked at today's Chicago's purchasing managers or manufacturing number below 50, and that's a harbinger of what the national number looks like, generally speaking. I also think we could see a protracted sideways market in the U.S. for, I'm beginning to believe that, we've had 3 tops since January of 18th, right around the same level. We've gotten stuck there. We do have likely this quarter weaker than expected profits. Their S&P 500 profits expect to be down about 2% or so. So I think, there aren't a ton of catalysts other than rate cuts that can move this market higher. Obviously, those are powerful. A lot of it depends on the trade talks this weekend, as everybody's already noted. And I also think the geopolitical risk is still somewhat latent and underappreciated.
Don't you love that setup, though, where we're already saying maybe even a 2-quarter earnings recession? And so that gives a much lower bar for individual companies to hop over.
Absolutely.
And I would prefer that than people extrapolating earnings growth out into the stars, which we clearly know is not going to happen.
No, I don't disagree with that. The way the market's behaving, it does not look like, unless there is a very serious catalyst, that you're going to just blow through the highs that you first saw in January of 2018, that you saw again in September, saw again recently. It's starting to look like, and people have forgotten these periods where from 1966 to 84, you slammed between 700 and 1,000 for quite a long time. We might be going through one of, it's early for me to make that call.
What's a very serious catalyst? You don't think, no new tariffs on China, Fed rate cut, are those catalysts potentially?
Those would be helpful, and a persistently.
But not enough?
Well, the Fed would have to be persistent. It's not just a take back of the quarter-point hike in December, right? I think they would have to make up their minds that they've got something to do on their hands. And again, Brexit out in October could be one of those issues that forces the Fed to go 2 or 3 more times.